course. And about 40 years ago, I began to give a quiz at the beginning of every class. These were second-year MBAs. I'd hand out a blue book, metaphorically, and I told them there are two questions. The first question is, identify the course that you had in the previous quarter or the previous year that you got the most out of. And I'd give them 30 seconds. And then I'd say, please write down the key ideas in that course. And I'd give them a couple of minutes. And then I'd turn to Jan in the first row and say, Jan, how many ideas did you write down? And there'd be a long pause, and Jan would say 2. And then I'd say, what was tuition in the course? This expensive business school, worthwhile. Jan would say $4,000 per course, and so we'd put 4,000 over 2, it's $2,000 an idea. And then, Jan, how long did you study? He'd say 10 hours a week, 10 weeks, 100 hours, over 2, 50. I've got 15 minutes for 2 ideas, right? And the first idea is one that goes back to Bob Triffin. Ned and I first met, wait for this. Ned and I first met in Bob Triffin's class in the autumn of 1956. If you do the arithmetic, that's 62 years ago. Something seems wrong in that calculation. 36, right, whatever. So Bob Triffin's main point was international consistency between or among currency areas, and that's the first point that I'm going to make. And the second point I'm going to make today is if there's an imbalance, that is, if the observed pattern of payments differs from the desired payments position, which is the independent variable and which is the dependent variable. So let's go to the first idea. The first idea focuses on the change in the U.S. payments position since 1980. Now, this is part of a debate I've been having with Ned for 20 or 30 years. One of the great climacterics in Ned's view of the world occurs about 1980. Something dramatic happened about 1980 with regard to American dynamism. And 1980 is the year in which the U.S. more or less moves from having a persistent trade surplus to a persistent trade deficit. And since 1980, we've had a cumulative trade deficit of about 15,000 billion, 16,000 billion. One of the observations of President Trump is that we have lost jobs in U.S. manufacturing. And the decline in jobs in U.S. manufacturing since 1979 or 1980 is $6 or $7 billion. I misspoke. The decline in jobs in U.S. manufacturing since 1980 is 6 or 7 million people. So in 1979, 1980, we had 20 million people at work in U.S. manufacturing. Now we have 13 million people at work in U.S. manufacturing. We've also had a very significant increase in the U.S. trade deficit. So the presumption is there is a causal relationship between the increase in the U.S. trade deficit and job losses in U.S. manufacturing. And I will now take you through some basic back-of-the-envelope calculations. What is value added per worker in U.S. manufacturing? It's about $100,000 per job, $130,000 per job. If I make the assumption that the value added in U.S. manufacturing per worker is $100,000. And I have a trade deficit of $600 billion, then the arithmetic is that job losses in U.S. manufacturing are 6 million, more or less the number of jobs that we've lost. But as I've indicated, value added per worker in U.S. manufacturing is slightly larger than $100,000. So let's say it's $200,000. That would mean that the job losses in U.S. manufacturing, because of the increase in the U.S. trade deficit since 1980, are 3 million. And that's the number I'm more or less comfortable with. Indeed, if you think of the job losses tend to be at, let's call it, at those industries in which have below average value added per worker, then this increases the number of job losses because of the increase in the U.S. trade deficit. It is an enormously large number. And that's the first point that I want you to take. That the increase in the U.S. trade deficit has been associated with a massive job losses in U.S. manufacturing. And let me come now to the second point. What is the causation? Well, we heard a bit of this from Jeff. And if I heard Jeff correctly, Jeff was sort of saying that the cause of the job losses, or some of the job losses in U.S. manufacturing, is the U.S. trade deficit. Is the U.S. fiscal deficit. And that's a very popular theme. It's a theme I identify with Marty Feldstein. Some of you may remember an op-ed in the Wall Street Journal in May of 2018 by Marty Feldstein and George Schultz. And it was that the trade deficit reflects the fiscal deficit, and the fiscal deficit reflects that large government expenditures. But this relationship works sort of both ways. If the cause of job losses, if the cause of the if the cause of the trade deficit were the U.S. fiscal deficit, then we might be able to identify certain countries that have larger than desired trade surpluses. I'll be prepared to take you to a free lunch, to take anyone in this room to a free lunch, if you can identify a country that believes its trade surplus is now too large. Do the Germans believe their trade surplus is too large? Or the Danes? Or the Swedes? Anyone want to take me up? I'll see you at lunch, and we can continue. We can continue the conversation. So the issue here is whether the U.S. demand for foreign savings is crowding out foreign borrowers, that is forcing them to pay a higher interest rate, and is subjecting them to a smaller amount of credit than they would otherwise get, or whether instead foreign savings is crowding into the United States and displacing American saving. That's the issue. Is it crowding out or crowding in? If it's crowding out, the independent variable is America's profligacy, and the rest of the world, Germany and China, are adjusting to our shortage of savings. Or is it crowding in? That there's an excess savings in Germany, trade surplus 9% of GDP. Netherlands, trade surplus 8% of GDP. Denmark, trade surplus of 5% of GDP. These countries essentially investing in the United States because they have, they're deficient in investment opportunities at home. Now we have several ways to look at this question. One way to look at this question is to identify is to identify the currency of denomination of transactions. Has the U.S. government issued securities denominated in a foreign currency to finance the U.S. fiscal deficit? Not since 1978, and our magic year is 1980. Foreigners are buying off-the-shelf U.S. securities. They're buying readily available U.S. real assets. Let's look at this from the point of view of what happens when there is an above-average increase in the U.S. capital account surplus, that is the U.S. trade deficit. Is that associated with a very low price of the U.S. dollar, or is that associated with a very high price of the U.S. dollar? Well, when I look at the data, what I observe is that the periods when investors are buying an exceptionally large amounts of U.S. securities and the U.S. has a large trade deficit, these are periods in which the dollar is very strong. So I might take you to the late 1990s. You remember the late 1990s. This was a period when the United States actually had a fiscal surplus. First time we had 4 years of fiscal surplus. We hadn't had a run of fiscal surpluses of that magnitude since Alexander Hamilton was Secretary of the Treasury. So we had a modest fiscal surplus and a very, very large trade deficit. It's hardly consistent with the view that the U.S. fiscal surplus is driving the U.S. trade deficit. So periods of the strong dollar tend to be associated with above average increase in the U.S. trade deficit, and that's because investors love U.S. dollar securities. And the third point that I would mention in this regard is the identity of the foreigners who have acquired 15,000 billion of the U.S. securities and real assets. And here there's a problem of non-congruent sets. But during this period, sovereign wealth funds, the Norwegian sovereign wealth funds, the United Arab Emirates sovereign wealth funds, etc., these sovereign wealth funds have acquired 8,000 billion of U.S. of savings, of net foreign assets. Hard to believe that any of these have done so to finance the U.S. fiscal deficit. What they have been doing is essentially taking a view of how do we optimize the value of our wealth? How much should we produce and how much should we consume? And the rest is used to buy foreign assets, and many of those foreign assets are the Americans. If we look at this, look at the acquisitions of U.S. dollar securities by foreign central banks, is about 6,000 billion since 1980. And these foreign central banks have been buying U.S. dollar securities, like the Chinese, to prevent an increase in the price of their currencies, or that is, to maintain an overvalued U.S. dollar. So let me come to these two main points that I want to leave you with. The second is that there is a strong relationship between the job losses in U.S. manufacturing and the U.S. trade deficit. And my ballpark estimate is that we've lost 3 million jobs in U.S. manufacturing since 1980 because of the increase in the U.S. trade deficit. The second point I want to leave you with is that one of the important independent variables is excess savings in foreign countries, that the United States has taken a very benign view toward the price of the U.S. dollar and toward foreign acquisitions of U.S. assets. And that benign view has been extraordinarily costly in terms of job losses in U.S. manufacturing. Thank you very much.
Thank you.